So good afternoon, everyone, and welcome back to the Mortgage Servicing Hotline. It's officially January 2026. Happy New Year's to everyone that's joining us today. I'm Brian Turner, and I'm joined today with Pat Taylor and Moyen Opemi. Now, before we get started, there is something I would like to discuss. So if you're in servicing currently, January doesn't necessarily mean New Year's resolution. It means more 1098, 1099 reporting, right? And I was just actually reflecting about this with the Vertex team. And I was mentioning that I remember the days of running shops and that had the legacy technology and reviewing the print logs and just praying that the data tape was right, working endless hours and drowning in, caffeine-fueled drinks for the entire month of January. And some of you are probably in that now. It was certainly a brutal time, but we always made it through, and the forms were always sent out on time. And quite honestly, that was one of the things that really fueled me to join Vertex, was being able to solve these kind of issues with software. It was always something, right? So I certainly don't miss the old way of doing those things. Now, with that being said, there is a bigger conversation that this started at the end of 2025, and it's absolutely going to define 2026, and that theme is retention. So we saw some massive moves in 2025 that indicate folks are finally looking at their servicing portfolio as something more than just collecting payments. We're seeing a real shift towards maximizing the borrower-member experience into a lifetime relationship. Pat, you mentioned in 2026, if you aren't looking at it through this lens, then you're missing the boat.
Oh, Brian, are you absolutely right? The folks, I'm so glad we're talking about this today, because servicing right now is really the number one source of the potential originations. The big players like, Rocket and UWM and even the big banks, prove this in 2025, because they were buying MSRs, the mortgage servicing rights, to those loans. And they were building what we're going to call technological sort of fences, because they know now, especially now, that the next loan that they may be originating is right in their own portfolio, because people are thinking about the potential for using the equity in that loan, or maybe they're thinking truly about selling and buying something else. But contacting those people already in the portfolio is what it's all about. And so those fences, we have to make sure, and Moyen's going to talk a little bit about exactly how people are doing that today. Moyen?
Yeah, exactly. And a massive +1. And I think the thing that's really interesting is the tech spend from like mortgage servicing has really moved from the perspective of, oh, we just have to offer something online, to how do we think about engagement? How do we nurture that relationship? And part of that is, hey, how do we catch borrowers at risk of leaving before we even know that they're looking, or before they might even think to look? And so it used to be just all about efficiency of, how do I get through the stack of checks as quickly as possible? How do I, send out statements as efficiently as possible? Or how do I just have some online solution to just, check that box? But now the focus has shifted entirely to engagement and relationship expansion. And I think that really builds a platform that is really valuable for a lot of people looking to not only maintain their existing mortgage portfolio, but to also build upon it in a lot of strategic ways.
Exactly. And that really does bring us to the headline topic for today, because if retention is the goal, there's a massive piece of legislation that we all know is dropping in Q1 that will change everything about how we keep our customers. So I do want to ask everyone now is we're going to launch a poll on the screen, is how many of you have heard of the trigger lead ban or the Home Buyers Privacy Protection Act?
Okay, and then I think everyone should be able to see the Q&A in the poll. And so we'll just take a moment and look at the results. Upvote if you have heard about it, and then if not, that's exactly what we're here to do, is to provide that education. So we will look at the poll now that it's live. Cast your votes. Don't worry, nobody's looking. And then just a few more moments. All right. And then maybe another 15 seconds, and then we will see what the results are. And so, interestingly enough, as we are looking at the final values, what we can tell is that it's something that isn't really published or pushed, because I think it's something that isn't really top of mind for some people that might not be in the zeitgeist, and then also is really important for those of us who actively have these relationships and have these mortgages that were originated across time. And so we will now just get the final vote in. And
So just looking at it, we have a range of responses. We see a lot of no's. So would you guys mind explaining what's going on there?
So, okay, so let's clear it up. That it is real. The bill was signed in September of 2025, and the clock is ticking down because the enforcement deadline is March 4th of 2026. Pat, for the folks who answered no in the poll, can you paint us a picture of what the status quo right now before the ban starts, and what happens when one of our borrowers decides to shop for a rate?
Well, I'd be pleased to be able to do that, and we'll answer any questions that come up, because this is so important. And Brian, you're absolutely right. Honestly, the status quo has really been, for many people who knew about it, a nightmare. We sort of call it the Shark Tank. Here is the reality for the last few years. Your borrower, let's call that borrower Sarah, decides that she would like to refinance. Now, that was probably happening, folks, to somebody who just wasn't happy. It wasn't happening to the folks who had a 3% mortgage that is now 10 years old and they had lots of equity. But Sarah might be calling not only for a brand new loan, she might be calling because maybe she needed a HELOC. Well, here's what happened. She wanted to refinance possibly, or a HELOC. So she called a lender, just one, and that lender pulls her credit. Boy, and tell them what happens from a technology perspective.
Sure. So within seconds of you showing up as that credit report pull, the credit bureaus will sell that data on as a trigger lead to 50 or sometimes 100 other aggregators. And who knows what goes on with your data once it reaches those aggregators. And so now, Sarah's phone is blowing up, 40 texts, 20 calls in the first hour. Meanwhile, Sarah herself just wanted to get a sense of, hey, like, what are potential options? Like, what might an actual rate look like? What are the amounts available? And as a byproduct of her just doing that initial analysis, she's now really faced with this subpar experience. And I think it's great when we're able to help consumers. And then also, as the person with that original relationship, is how do we actually protect Sarah from that event? And so that kind of goes back into the purpose of the trigger lead ban.
Wow. And so thanks, Moyen. And folks, for those of you who didn't understand that this was kind of going on behind the curtain, it is a real issue for us as servicers and as sub-servicers. You're at a constant risk of losing what could be a long-term relationship, whether that for you as the servicer or you as the lender, simply because the credit bureau sold access to your customer to the highest bidder. And we didn't realize, if you think about it, some of you may have experienced this where, you had a sort of passing conversation with somebody about rates or what their products were, and all of a sudden you're getting these calls. So you as a servicer spent perhaps years, or as a lender, years building that trust with someone like Sarah. But the moment that she shows some interest, 100 strangers are given a map directly to her front door to be able to contact her and talk about their organization. So what has happened in March, that logic finally breaks. By removing those 100 aggregators, what happens is the law stops the bureaus from selling your relationship out from under you. For the first time, you aren't just another shark in the tank. What you are, you're the one that established that relationship. Whether that was a relationship with you as a lender or you as a servicer, and the legal right to be there, it shifts the power back to the folks who actually own that loan or own that servicing.
So,
Important for you to understand. Brian, so, if you don't mind, would you for just a moment kind of talk about the law that has been passed?
yeah. So to explain the shift, that new law bans the bureaus from selling that data to random third parties. But Pat, do you think there's a huge exception for us?
Yeah, I do. Absolutely, Brian. No, you're right. The law says that you cannot sell Sarah's data to strangers. But, and this is a big but, folks, you can sell it to the company she already has a relationship with. And that's really important because that means you, the servicer, or possibly you, the sub-servicer, who has all of the information on that loan, is going to be the only person that they can sell that information that Sarah's been looking, and Sarah has some questions to ask. And so, boy, and what do you think? I mean, we consider it sort of a golden ticket, but we have to get on it, don't we, pretty quickly?
Correct. And so it's certainly like a golden ticket, where you don't have all those sharks swimming around that relationship. And so the upside is the water is clearer, in which you don't necessarily have those 100 aggregators that are reselling that data. But at the same time, if she applied to get credit, that means that she's already progressing with this other lender. And so it's a double-edged sword, in which, you still can get notified. But at the same time, that means that your homeowner that you have that relationship with is potentially looking to leave.
Yeah.
Yeah, and I think the great part about that is that it gives you an exclusive lane to talk to your borrower.
Do you think, though, Brian, I think this is important. And I think that as we just found out, that there were a whole lot of people that didn't know about this, so the but is kind of important. If we don't contact that borrower, if we wait for that trigger lead, it's still going to be an expense. Why? Well, the bottom line is you're going to talk a little bit about how they pay for it, but I'd like to talk when you're finished about the circumstances associated with what we need to do before that even happens.
Well, let's dig into that a little bit. So, because even though the sharks may be gone, so to speak, is waiting for the trigger lead actually the best strategy?
And I'll hop in right before we head towards the Q&A to talk about this final strategy component, because the issue is you're essentially paying $50 to save a borrower who's already leaving. So that means that they've already gone far enough down that origination process where they felt comfortable having that credit report pulled. And so I think the real question now is you have to have the resources internally to get ahead of that. So how do you actually stop that first step of them looking outside of this relationship? And so what we think is technology is actually the really good lever to help you with that. So what you can do with technology, and something that we've developed at Vertex, is the ability to constantly monitor your portfolio for these specific insights. So how do you know before that homeowner themselves might know that they might be looking to refinance, or take out a HELOC, or do some sort of activity? And so you need you need a system that's able to look at the equity in the home, the rate spreads, the real-time property value, different life events, and look at that every single day, and not once a quarter or something like that when there's an issue that arises. So how do you proactively make this a more advanced and automated system? And so I can completely go into more detail if people have a question on that, but our system essentially says, like, hey, can you automatically figure out the probability that someone's looking to do something? And then can we surface that list of the 500 to 1,000 people that we can automatically trigger those communications? And the great thing, though, is that cost of that lead is zero. It is your data that is just working intelligently for you. And so I think at the end of the day, you just need the right technology to power this portfolio retention and management. And so, Brian, I'll let you take it away before the Q&A.
Okay. So, don't buy the lead, build the lead. That's the 2026 playbook. So we have some great questions coming in. The first one hits on a different side of the portfolio. How should we think about retention from a modification or delinquency perspective? And the second part of that is, does the strategy challenge when looking at a GSE versus a portfolio loan? Pat, what's the experience there?
Well, it is not only we've seen the numbers, Brian and Maureen, but when an institution really is so concerned about the relationship with that borrower, okay, and they recognize what's going on right now, it's a pretty sophisticated question, and it has a sophisticated answer, but Moyen is really giving you a hint to that answer. In other words, if your system or if your people have been trained to use the system, to take a look at what might be the case with a particular loan. If we are looking at, how we think about retention from a modification or even from a delinquency perspective, think about what would happen if we've seen a person whose pattern just recently changed. So we have to ask ourselves, does the strategy change for how we communicate with them? In other words, instead of a collection call, we might be making a call, an outbound call that says, we're looking at your loan from the perspective of if we own it, or perhaps if it's in a GSE portfolio, if it was sold to Fannie or Freddie. So what becomes the experience for that borrower? We know already, for those of you who have very tight relationships with your borrower because you're perhaps a credit union or a small community bank, and you may be thinking about that already. But the circumstances are that, as Moyen said, for the GSE loans, you're obviously constrained possibly by a specific waterfall. But at least if you know that it's a GSE loan and you know what that waterfall is, you can make that outbound call to someone. You are not ever making it like a collection call. You're making it as a call that says, folks, there's lots of things going on right now. And so before they fall off the cliff, or before a competitor offers them a fresh start, what you're going to do is you're going to think about that loan in terms of retention, and you're going to think about how you might be able to help them to turn that delinquency and potential in 46 days of default. It isn't just about the loss mitigation. It's about making sure that we're protecting that mortgage servicing revenue and value before it just simply goes away. And so it's why we thought about introducing this particular short half hour But we want your questions and we want you to bring them into us, and anytime you have a question, you are going to be able to send that in, because beyond the data, that is the most important thing in your portfolio. As you heard Moyen say, it's about being able to get to that information, to be able to set up some good people who are really good making outbound calls on the phone, so that you're able to process what could be an opportunity for a hardship application. And by the way, for those of you who don't know, if you're lucky enough to be able to take a look and see that pattern change quickly and get a weekly report, for example, from your collectors at a weekly meeting that you set up, where you can help them to understand that that's hardship application, they can help them to fill it out. They can help them to send it in. And we want to make sure that you know and that your borrowers know about how opportunistic that hardship application. Some people call it a borrower response package. Some people call it a 710 set of forms. But the point of the matter is that those online applications can be done very effectively, very quickly, and quite frankly, delivered quite easily and quickly, either to the GSE or to you as the owner of that owner of that loan, and possibly the owner of the servicing as well. And that way you can analyze what's going on, not only with that particular borrower, but potentially what's happening in the whole of the portfolio. And there are some hidden signals, folks, that maybe you can't see. So be sure to clear the way for folks to request a hardship application. And in today's market and this particular time that we're in right now, without a great deal of guidance anymore from the CFPB, but we've had experience using those options, and the circumstances are that we can get that. Tell them about that, Brian, in terms of, the next one that Moyen's going to talk about.
So, Moyen, do we want to? I see there's a question in the comments, I think, related to this portion of the conversation. Do we want to go ahead and address this question?
Of course. Let's dive into the question. Can you repeat the question in case people don't have the chat open, and then we'll kind of get into our thoughts on that.
Okay, this is from Alice, and I really do like this question, because this is not the first time I've heard this. How can we actually do this if it's already hard to do collections calling, we're short on people?
Yeah.
And, and so
I was going to say, Moyen, I just think one of the things that I just want to repeat, and this is so important, is that it wouldn't be a collection call. You might meet with your collection people literally once a week and look at the reports to see patterns that have changed, or where there's equity in a loan, but the pattern has changed. And
Sure.
So it's very important to understand. Moyen, tell them what you think about, if they're feeling brave and adventurous.
Yeah, and so I think to get to the idea is, I think collections calling and being short on people kind of builds into that larger theme of how do you actually get the work that you need done? Because typically people are short on, resources and staffing. And so I think that comes to the idea of what your technology platform can do. And so from a collections perspective, yes, like for those tougher conversations that are more nuanced, a lot of your time should be spent on that phone with that homeowner. But in terms of dialing, in terms of sending out more general information, and in terms of lower level conversations, your system that you use should actually be able to help you with that process of automating the outbound calls, identifying who needs those 16 to 29 day calls. And the purpose of it is to then free your team up to do higher value activities where it's going deeper with someone already deep into delinquency. It's going deeper with people that are like, hey, I have a lot of equity in my home. How do I, capture some of that? And so that kind of goes to the next question that we have of, how do we actually implement this? And so a lot of people are like, hey, like, let's just grab some, off the shelf AI tools. Let's go get Riplet, which is, to build some, SaaS or software in-house. And so it kind of comes to the question of, do you want to commit to the next 20 years of maintaining that software in-house, in which hopefully your internal IT teams priorities don't shift, year to year, or technology doesn't go obsolete, or dare I say, there's any security risk. And so basically by trying to build all these automation tools in-house, you're bringing on the commitment to say, hey, for the next X number of years, we're going to build, maintain, update, and secure the system that we built, even though the people might not have the time and resources in the future. And so from my perspective, that's a really big upfront commitment. But on the flip side, what you can do is find a technology provider that is able to scale with you as you grow. And so what you're able to do is say, like, hey, like, these people are solely focused on this mission of making it more efficient for me to connect with these homeowners, whether it's on collections or opportunities to refinance or an opportunity to take out an additional HELOC. And so if their sole focus is on building that mission, they're then able to get other visionaries and software engineers that are really passionate about that same thing, in which they're then able to really focus on security, making it updated, and actually folding in a lot of insights and perspectives from people that are similar to you and making the product as good as it can be. And so Jeff Bezos often says, focus on what makes your beer taste better. And so in this case, unless you think you can build the world's class, Google level talent, you're probably better off finding the right technology partner who's really focused on this initiative, and then leaning in on them and making sure that, as a partner, they understand what you're looking to accomplish both now and then also in the future. And so with the right technology, you actually will have the resources to still do the day-to-day, because a lot of that should be automated, and then also kind of reinvest in higher level engagement, whether it's, minimizing the loss from delinquency or having these conversations of being proactive with that member.
Okay. So we do have another question, but it looks like it might have come from our last session. I think due to time constraints, Moyen, do you think we should just reach out to them directly?
I think we can, but I think what we can also do is go through the question, and I can definitely take it. I will be brief. I'm on a 60-second shot clock.
Okay. Well, the question is, how does the escrow management tie into the proactive retention model? Does an escrow shortage notice actually create a leaving risk?
Sure. And so the shot clock has started. So essentially, yes, an escrow is often the first time someone looks at their statement and says, I don't know if I can actually afford what I signed up to do. And so if someone happens to come across them and says, hey, there's a no cost refi, they'll probably, go with that person. And so essentially you're in trouble as the lender. But if you compare that with your retention strategy of saying, hey, can we find people who have had massive increases in escrow? Can we proactively engage and communicate with them with something that's relevant to them, such as, hey, like, we can refinance you so that way your total payment comes down? That's a pretty good strategy to me, to, helping them actually retain and using that tough escrow moment to actually build that relationship even more. How was that for 60 seconds?
That's perfect.
Great.
So we are coming up on the half hour, so we're going to wrap things up. If you have a burning topic we didn't get to, or if you'd like a deeper dive into something else or how the law affects your specific portfolio, please feel free to reach out, via message directly to myself or Pat or Moyen or IO, and we'll be glad to get back to you.
Sure. And if anyone has any questions on building a tech stack or, the tools to build what you're looking for, feel free to email me at moyen@vertex, MOYIN @vertex.io. I'll drop it in the chat. And thank you all for joining us on this January hotline. We'll see you again next month. We'll be at the MBA Servicing Conference, so don't be a stranger. Definitely stop by as we look forward to having this conversation in person again.
Thank you, everybody, for your time. Have a great day.
Bye, everybody. Don't forget to send in those questions if you have any.
Yep.
Perfect.
Bring some more people next time. Thank you.